Reciprocal, that means they do it to us and we do it to them. Very simple. Can't get any simpler than that. This is one of the most important days, in my opinion, in American history.
Good morning from our global headquarters in New York City. I'm Matt Miller in for Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda for the day. Tariffs rattle markets with a sweeping sell-off in global stocks. 10-year yields drop towards 4%, and the dollar dips the most since 2023. Leaders from Europe to China vow to respond with countermeasures to President Trump's levies, and don't miss our interview with the foreign minister of Finland as the NATO summit kicks off in Brussels. First off, let's get a check at what's going on in markets this morning. As I said, a big sell-off globally, but it's hit the U.S. hardest. S&P futures down about 2.8%. NASDAQ futures off more than 3%. And the problem is a lot of those tech stocks that Francine was just talking about with the EU parliamentarian are the biggest losers. In terms of what's going on with other assets, you can see bonds price up, yield down. So the 10-year yield at 4.0757 right now off 5.5 basis points. And then take a look at what's going on in commodities. We saw a surge initially in gold. Right now it's back down, but at $3,127, not far off from the all-time record it hit just a couple of days ago. Brent crude off 3.5% as the global benchmark sells off $2.64, now trading for $72.28 a barrel, and NYMEX crude well under $70 at 69 even. We're also keeping an eye on Lululemon sinking as it's just one of many retailers getting hit by President Trump's tariffs, which will raise costs on apparel makers. You can see the drop there, more than 10%, so that stock getting absolutely decimated. And wherever you look across retail, that's the case. Deckers, Ralph Lauren, Restoration Hardware, all getting hit hard. Tesla, you can see, down more than 3%. Other car makers are not taking quite as hard a hit as the president's auto import tariffs take effect today. However, many thought the EV maker may be one of the few winners when the tariffs were announced, as a substantial portion of its components are made right here in America. You can see Amazon falling after the Mag 7 gets dragged down by the tariff announcements. Amazon off almost 5%. The tech giant has submitted a bid to the White House to buy out TikTok before its April 5th deadline, which you'd think is unrelated to tariffs, but the president himself has tied the two together. And coming up this hour, we have a conversation with Rabobank's Jane Foley right around the corner. Plus, Frank Monkam of Buffalo Bayou will join us later this hour to talk about the tariff effects on global markets. Now, Donald Trump's announcements yesterday triggering the global market sell-off. The president announced the U.S. will apply a minimum 10% general tariff on all trading partners, as well as additional duties on around 60 nations.
China, 67%. That's tariffs charged to the USA. So we're going to be charging a discounted reciprocal tariff of 34%. European Union, they're very tough. We're going to charge them 20%. Taiwan, we're going to charge them 32%. Japan, we're charging them 24%.
The higher tariff rates that the president has billed as reciprocal will kick off on April 9th, according to the White House. U.S. Treasury Secretary Scott Bessent told Bloomberg that America's trading partners should not respond in kind for now.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. And I think the market could have certainty that this is the number barring retaliation.
For more, we're joined by Bloomberg's Brendan Murray, who leads our global trade coverage. And Brendan, let's start with the numbers the White House gave us in terms of tariff and non-tariff trade barriers, as well as currency manipulation that other countries essentially charge us. Are those numbers in the ballpark of what economists believe to be true? I mean, does Europe really have 40% trade barriers on our goods going into the EU?
Yeah, well, we're still trying to parse the numbers and look at the formulas that the U.S. trade representatives, their office, use to come up with these calculations. But essentially, they're going after, not just countries that have big trade imbalances with the U.S., but pretty much all countries. We have the 10% baseline, and then the 60 or so countries that get a number that's above that, ranging from, China gets 34%, Vietnam 46%. And other countries in Southeast Asia get, something north of 40%. So we're still trying to understand how they arrived at these numbers. It's a bit of a shotgun approach and some targeted measures, but for the most part, there isn't a country of any size that that emerged unscathed in yesterday's announcement.
Brendan, the EU chief Ursula von der Leyen said that they are already preparing countermeasures, as she called them, if negotiations fail, she added. So are we to understand, especially since these tariffs don't kick in immediately, as we were originally led to believe, but on April 9th, that the White House wants other countries to negotiate with him?
Yeah, I mean, there's very little time to negotiate out of the tariffs that the Trump administration is putting into force over the next few days. There could be some hope that you could make your case to the administration. But by and large, these are going to take effect by early next week, and we're going to be in a global trading dispute situation where countries are going to have to decide: do I want to retaliate and risk a further escalation by the U.S., or do I want to try to play the long game here and see if there is room over the medium term to get those tariff levels down? At this point, it seems like some countries got a bit of a break. The UK wound up with only a 10% tariff. But as I said, some of these countries in Asia, longtime U.S. allies, Japan and Korea, they're looking at rates of about 25%.
Brendan, thanks very much. Brendan Murray there covers global trade for Bloomberg News out of London. Very busy day, obviously, for you, so appreciate your time. Joining us now to talk further about this is Jane Foley. She's the head of FX strategy at Rabobank. And we did notably, Jane, see the dollar drop, the biggest drop, at least in terms of the Bloomberg Dollar Index, since November of 2023. What do you make of the headline announcements out of the Trump White House?
Well, of course, they were generally worse than the market had anticipated. Of course, we knew that there were going to be tariffs, but these are at the top end, really, of many market forecasts that we had. So hence the very significant market reaction. I mean, there had been many analysts over the last couple of months thinking, these tariffs, they're up for negotiation. They may not happen. They may be temporary. But certainly the tone of what we got yesterday suggested that Trump very much wants to use these tariffs to try and relocate manufacturing back to the US, and that means heavy tariffs. Now, we did hear, of course, that the UK, Australia, for instance, got let off relatively lightly, but some countries, Japan, South Korea, China, of course, as well as the EU, have been extremely hard. And that, of course, is exactly why we're seeing stock markets falter so much, and why the reaction in the dollar has been so large as well.
What do you make of the reaction from Ursula von der Leyen and others? It seems they're preparing countermeasures, looking to retaliate rather than lowering their trade barriers in an attempt to negotiate. Is that, you think, going to be the case for everyone? Can we assume retaliation?
Well, we've got to remember that politicians need votes, and of course, many of the people that vote for them, want to be seen as standing up firm, and they don't want to be seen as cowering to what they may perceive as bullying by the Trump administration. So politicians are caught between that that and the fact that they are still reliant on this relationship, particularly, say, in Europe with respect to defence, for instance, they do need to preserve that relationship as well. So it is interesting that although Europe has already prepared counter tariffs to the aluminium and steel Trump tariffs that were announced earlier on, that they haven't yet been enacted, and yet we've still seen von der Leyen, for instance, say that counter tariffs, that these tariffs, the latest tariffs, will only be put on if talks falter. So they still want to push the fact that they are the ones that want to talk, but they will, and they are prepared to stand up firm if needs be.
Okay, Jane, you're going to stick with us here. We want to talk with one of those politicians right now. Rabobank's Jane Foley will stand by. Tariffs have been obviously unveiled. Markets are responding rather negatively, but so are nations. Let's go to Brussels, where Bloomberg's Oliver Crook is live at the NATO Foreign Ministers Summit. Oliver?
Yeah, good morning, Matt. Listen, it's a NATO Foreign Minister Summit. The focus here is really supposed to be Ukraine and the future of European defense, but we cannot really avoid the question of tariffs, just given what we've seen over the last 12 hours. I'm very pleased to be joined by Elina Valtonen, who is the Foreign Minister of Finland. So thank you so much for your time this morning. I'd just like to get your reaction from what we got from the Rose Garden yesterday and the United States and its trade barriers, now 20% with the EU.
I so hope this is just an opening to fruitful negotiation, which will lead to a situation where we actually have less trade barriers, especially between friends and allies. Because the only thing that tariffs and trade barriers achieve is that essentially the purchasing power of people goes down on both sides of the Atlantic, or essentially in this case in the entire world, but most notably that of the Americans. And this is certainly not something we want for our American friends.
And in this sort of conversation around tariffs, again, he's trying to seem to solve certain problems. It's not really the tariff level between the EU and the United States, but it's sort of these non-tariff trade barriers. Do you have a clear idea of what the United States wants, and do you think the EU is going to be able to provide that and get those tariff levels down?
You know, the reason that the United States is the most prosperous and the most powerful nation in the world is because of a transparent market economy. A market economy that all of us in the rest of the world have been very envious about. In Europe, we have come very close to achieving that, and of course, we have had significant successes also in our transatlantic trade. Essentially, we are the biggest trading partners, the US and the European Union. And this is exactly the path that we should be continuing on, I think. And I hope that we will come to a stage where essentially we will slash everything that hinders the trade between us.
And just a final question on trade before we get to the business at hand here at NATO. The other sort of consequence of these trade barriers is between the United States and China, huge amounts of overcapacity now threatening to come into the EU market. Do you think that trade barriers between the EU and China will have to be elevated to basically prevent that from happening?
We'll see about that. And sure, the European Union will react. But the main thing is that, again, as at the core of a functioning market economy is each and every individual, the consumer, who has the freedom to choose. And this freedom to choose also in the United States has led to the fact that yes, there are some, trade deficits, some trade surpluses, depending on which country you look at. But at the same time, this has exactly given the people the prosperity and the purchasing power which they deserve. And this is something we will also be cherishing in Europe. And again, we hope that we can go back to normal as soon as possible.
And so Finland, with sort of the biggest NATO border with Russia, obviously front and center, defense, Ukraine, this is going to be the sort of main object of conversations here at NATO. What do you need to hear from Secretary of State Marco Rubio, who will speak in just a few minutes' time? What are you hoping to hear from the Americans here?
First of all, I'm happy to welcome Secretary Rubio to his first NATO meeting. I'm sure that this will be a very fruitful meeting, also committing strongly to the transatlantic alliance and also committing to the fact that we essentially share the same threat landscape. And the threat is coming from not just Russia, but also the rest of the autocrats in this world. And together, we have to be defending the free world.
And how do you make that case to him? Because, this is the point that has been made by Europeans for a very long time. It is not necessarily cutting through to the Trump administration. Do you think enough has been done in terms of the targets for NATO? Do you think that we're going to have to look at getting that target higher overall in order to persuade the Americans of the European commitment?
What the Americans have observed over the course of the past weeks and months, I hope, is that Europe really is taking this seriously, that we need to be better taking care of our defense and deterrence. And this is certainly what Finland has been doing all along. This week we announced that we will be spending at least 3% of our GDP into defense, and this doesn't even count our conscription-based army. We have one of the strongest armies in Europe, and we just hope that each and every European member state will follow course, and so many have. And together we will make the transatlantic bond stronger.
And are you willing to go to that 5% figure that Trump has been talking about for the last few months?
See, if we enter a recession now, which means that the GDPs of both sides of the Atlantic will go down, it will be easier to reach any share of the GDPs, say 5% of the GDP if the GDP falls. But this is not what we need, because we need true capabilities. And true capabilities need, of course, the euros or the dollars to fund them, but also the industry behind it. And now should be the time that we work together to really ramp up our defense industries, our defense and deterrence together.
Well, Elina Valtonen, thank you so much for your time here from NATO headquarters. That is the Foreign Minister of Finland. Just moments before we'll hear from the U.S. Secretary of State Marco Rubio speaking here in Brussels.
All right, Oliver, thanks very much. Oliver Crook there in Brussels at the NATO summit. Taking a look at what's going on in markets right now, you just saw Russell 2000 futures down more than 4%. NASDAQ 100 futures off 3.3%. We do see some of the biggest tech stocks in America getting hit incredibly hard, including Apple. And S&P futures right now down more than 3%. In terms of treasuries, investors are buying those, so price up, yield down. You can see that's true in the middle of the board there. The 10-year off about 6 basis points right now at 4.0719. And then commodities are interesting because we have had gold run up to an all-time high recently, and we're not far off that at 3,127. But the reaction in oil is especially stark, with NYMEX crude falling below $70 off $2.65 to $69.06, and Brent down to $72.32. Of course, the dollar reaction has been significant as well, and I want to get back to Jane Foley, head of FX strategy over at Rabobank. Currency manipulation was one of the big complaints of the Trump White House yesterday, Jane. They lumped that together with non-tariff barriers and tariffs to come up with numbers that were eye-poppingly high, saying that China charges essentially 67% on U.S. imports, that Europe charges essentially 39% on U.S. imports. Do those numbers ring true to you?
Well, certainly we've seen the animosity between Trump and China for so long. Now, it is, of course, an exchange rate or a regime which isn't freely floating. So there is a little bit of credence through there. But some of Trump's accusations about currency manipulation, for instance, haven't necessarily fallen on sort of agreeable terms. For instance, if we look at Japan, the last interventions that they were doing in the currency market were to strengthen, not to weaken their currency. So those accusations perhaps don't play true. Now, of course, what is perhaps ironic in this is that in currency circles, there is a discussion about whether or not Trump's administration would try and move towards trying to fix the US dollar at a weaker position in order to try and tackle the US trade deficit. And that perhaps is still going to be something that the market is going to be keeping at the back of its mind if these tariffs perhaps aren't working as quickly as Trump wants.
We do see the dollar weaker against all major trading partners, even though expectations are for the Fed to hold pat and for the ECB to cut sooner. Why do you think we see this movement in currencies, and what do you expect from central banks?
You know, I think it's really interesting. I mean, clearly, since the beginning of this year, the majority of the reason that the dollar has fallen is because the market has thought that the Fed would come in and cut interest rates. Now, that, of course, sort of looks through the fact that tariffs are also being inflationary, and that stands true for the other G10 central banks, and the possibility that reciprocal tariffs on the US could also raise inflation projections elsewhere as well. So we have right now, you know, this growth concern that seems to be the predominant focus of the markets. But I think for the dollar, the fact that we haven't seen today the safe haven flow into the dollar, we've seen it into the Swiss franc, we've certainly seen it into the yen, but we haven't seen it into the dollar. And I wonder if this is because the market is wondering whether or not, A, there's going to be an acceleration of de-dollarization, perhaps, because of the isolationist policies that Trump is backing. If so, perhaps that's a little bit premature. But the other reason, is the market wondering whether or not Trump will try and push for some sort of accord to weaken the dollar, to tie in with these tariffs. And if so, could that happen relatively quickly? Could that happen this year? So I think there's a couple of ideas, kicking around, but I think the major reason that the dollar has fallen is this perception that the terminal rate of interest from the Fed could be lower than it was perceived before. And for that reason, what Powell has to say tomorrow is going to be very interesting.
Jane, what are the most interesting pairs you're watching, and what are you advising clients right now on FX?
Well, euro-dollar has to be the most interesting pair. We've seen such a big move in that over the last 6 or so weeks. Now, we do think that euro-dollar will go higher, on the 6-12-month view, but I do wonder if today's reaction, today's sell-off in the dollar is a little bit too rapid. So I think we're going to see certainly some choppiness. The yen, I really like the yen, for some time, and I think that's got further to go. But again, what the market must face today is the reality that huge 25% tariffs on Japanese auto imports into the US, plus, the other tariffs could slow the recovery in the economy, and therefore could slow the pace of interest rate hikes from the Bank of Japan. So again, I think the yen is perhaps a little bit overextended, even though I think the trend is in the right direction. But generally, sterling, there's so much out there right now that has moved so much in the last 12 hours or so, and I think is really fascinating.
All right. Well, it's great to get some time with you this morning. Thank you so much for spending it with us, Jane. Rabobank's Jane Foley, who runs FX coverage there. Coming up, we've got to look at what else is making headlines around the world as futures fall 3% and more here in the U.S. U.S. stock market getting hit harder than the rest of the world. And we're watching especially retailers this morning as Lululemon, Ralph Lauren, Nike, Walmart, Amazon all get hit. Tech stocks down, especially Apple in the pre-market, and financials taking a big hit as well. This is Bloomberg. This is Bloomberg Brief. I'm Matt Miller in New York City. Time now for our front page news. First up on Bloomberg, Senate Republicans unveiled a budget blueprint designed to fast-track a renewal of President Trump's tax cuts and a debt limit hike. The plan would allow for a $4 trillion extension of the tax cuts and an additional $1.5 trillion in more tax reductions. Republicans say they are assuming that extending the expiring 2017 Trump tax cuts won't have any cost at all. Next up on the Wall Street Journal, Volkswagen is adding an import fee to the stickers on its cars that are affected by the 25% vehicle tariff. The company told dealers it would give more details by mid-April on pricing strategies for tariff-affected vehicles. The German automaker said it would work with logistics companies to optimize vehicle movement once the tariff situation stabilizes. And on the Financial Times, Apple is one of the many tech companies hit as President Trump targets suppliers. It will hit the company's manufacturing centers in China, India, Vietnam, Malaysia, and other countries as well. This is Bloomberg. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Matt Miller in for Danny Berger. Let's set your agenda for the day. Tariffs rattle markets with a sweeping sell-off in global stocks. 10-year yields drop towards 4%, and the dollar dips the most since 2023. We have seen bigger moves in the U.S. than elsewhere, and we've also seen some big moves in commodity with oil falling down below $70, at least on the NYMEX. Volkswagen plans price hikes following the tariffs. We'll look at the impact on sectors from autos to retail. Retail getting hit the hardest. The numbers are eye-popping in the pre-market. And here you can see futures down 3% on the S&P, more than that actually now. NASDAQ 100 futures down about 3.5%, and Russell 2000, the small cap futures, falling 4.5%. In terms of treasuries, investors are buying there, so price up, yield down. The 10-year yield at 4.06% right now, so falling a full 7 basis points, getting closer and closer to that 4% level as the 2-year falls down below 3.80, the 30-year under 4.5%. In terms of commodities, I mentioned oil, NYMEX crude falling further now, almost 4%. Or $2.80 a barrel to 68.91. Brent crude down to 72.19, and gold, it's off a little bit, but still close to its all-time high at $3,125 a troy ounce. President Trump announced the U.S. will apply a minimum 10% general tariff on all trading partners, as well as additional duties on around 60 nations. Markets are reacting, and so are world leaders.
Tariffs and a trade war is not good for global economics.
We're going to fight these tariffs with countermeasures.
The impact is not so much the impact in our trading relationship with the US, it's more about what this means for global economics and global headwinds.
We will not join a race to the bottom that leads to higher prices and slower growth.
We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
Joining us now to unpack the new global trade regime is Bloomberg's Joshua Gallo, Oliver Crook, and James Mager. And Josh, let's talk first of all about the tariffs themselves. How severe are they, and are they here to stay?
It's a great question. That's what many countries are asking right now. So the basic way to think about these tariffs, we've seen some come out of the administration already, some that were leveled on national security grounds, like on metals. There were others that were trying to prod countries to do something about the fentanyl crisis. These are ostensibly to address trade deficits, which are something that have bugged Donald Trump since his first term. And it's a blanket 10% tariff on all exporters to the U.S. And then on top of that, of course, he's taken a deeper look at which countries have the biggest trade surpluses with the United States and top those off with another bit that's meant to even it out. At the top of the list, you have China, of course, is the biggest one. And they're going to suffer the most. They have an effective rate that's now going to be, on average, above 60%, which Bloomberg Economics estimates could wipe out a lot of the trade between the two countries by the end of the decade if it does stay in place. So you can imagine that with all the South Asian countries that are at the top of the list, as well as the European Union, a lot of goods are going to be much more expensive for Americans going forward.
Oliver Crook, let me get to you. You're in Brussels at the NATO summit. What kind of reaction are you hearing from world leaders? Are they looking to retaliate or potentially lower trade barriers and negotiate?
Listen, we have the unified voice of the European Commission, Ursula von der Leyen, basically saying that they'll only retaliate if they cannot negotiate an outcome. So really the preference from the European Commission and the EU is to figure out a way to get past these tariffs, to get into these negotiations and try to bring that level down from that 20% to, I guess, the lowest they can get is 10%. The issue is, Matt, is that when you actually look at the tariff rates between the EU and the United States before yesterday, there's only about a 0.5 percentage point difference, right? So what the Trump administration is looking for is non-tariff measures, the so-called non-monetary trade barriers that Trump was talking about yesterday. And that is what the EU needs to figure out how to basically present that to the United States and to Donald Trump. The question is, what is the equivalent to a sort of a tariff rate for something like, in terms of food quality regulations or potentially digital taxes or VAT? What is the equivalent there? And that is the equation that the European Commission needs to figure out. And we should say, Matt, that within the EU, there's going to be different views on this, right? Germany is super exposed when it comes to the export market. There are other parts of the EU that are more concerned with Russia and want to keep the U.S. on board in terms terms of NATO and defense. So it's a complicated equation, as ever, for the Europeans here.
Fascinating stuff out of Brussels there, Oliver. Let's get to James Mager right now in Beijing. James, you know, these are some of the highest tariff levels that we're going to see because, as I understand it, they all add up. How are the Chinese responding, and what about Chinese businesses?
Yeah, as you said in the introduction, the actual tariff on Chinese goods now is more than 65%, and this is going to be very, very damaging for both for Chinese exporters, but also for U.S. importers. iPhones are only made in 2 places in the world: it's China. The vast majority are made in China and in India. Also just been hit with U.S. tariffs. So if you're a Foxconn making iPhones in China, this is going to hit the number of people who can afford your phone. And if you're an American consumer, it's going to hit the number of people who can buy the phone. But it is going to be very damaging for Chinese businesses and for foreign businesses in China. So far, the government hasn't done anything. As I would expect, based on previous actions, they'll wait till the tariffs actually come into place either this weekend or early next week. And then once the U.S. tariffs actually are put in place, they will respond with some kind of retaliation. But I think what we've seen so far is China does want to talk about these things. They have the retaliation to the previous rounds of tariff because of fentanyl were quite limited. They were much smaller than the U.S. action. So I think there is still a desire to talk, but the kinds of demands, or even the lack of demands that the U.S. is making on some countries, make it very, very hard for them to discuss these things. If the problem is the massive trade surplus that China runs with the U.S., this is not something that can be renegotiated and changed overnight. There is, it's taken decades of building up supply chains to get to the point where they have this huge trade surplus. It's going to take a similar amount of time to reduce that, or to change where companies make things, to change the surplus that everyone in Asia runs with the U.S.
James, thanks very much for joining us. James Mager for the day in Singapore, it looks like, normally based out of Beijing. Josh Gallo out of Munich, and Oliver Crook currently in Brussels. Joining us now is Frank Monkam, head of macro trading at Buffalo Bayou. Frank is here with me in studio. Thanks for getting up early and coming in. Pleasure. What do you make of the headline announcements out of the White House? Do they seem to be worse than many had anticipated?
Yeah, thanks for having me, by the way. And just want to start by saying that, maybe just to put a bit of context around this, I was on this very program late last year around Christmas, and basically saying that I don't think it's anybody's ready to have an investment outlook for this year until we get through the first 100 days of Trump, because we just don't know what the policy agenda is going to look like, the sequencing of it, the content, et cetera. So we're here today. And what's transpired out of D.C. over the past, 13 hours, 13 hours ago from now is just nothing shy of a grand opening of, volatility season. I think nobody really saw this coming. We knew tariffs were going to come. I think a lot of the, market participants believed that it was going to be something akin to what we saw in Trump 1.0, but it's completely different. I think it's important for investors to really step back and kind of think about this holistically and realize that these tariffs are just a piece of the bigger puzzle. And the bigger puzzle here is the so-called reset theory, that comes from sort of the Mar-a-Lago Accord, right? Which is fiscal austerity, trade protectionism, weakening the dollar, perhaps get into some debt swaps. They're really concerned about the debt. Right, and we've talked about this before. I mean, I think everybody kind of knows this already. There's really no Trump put out there. There's a Besson put on treasuries. And what investors need to think about is really ask themselves one question. Do you believe in the reset theory or not? And if the answer is yes, then you need to have a game plan accordingly. And that game plan means that we're probably going to be in the market that's very similar to 2022. It's going to be 2022 2.0, no pun intended. And the only difference really is you've got a policy-driven bearish pressure on this market. But in 2022, it was really driven by monetary policy. Now we have a situation where it's going to be driven by fiscal policy and trade policy.
Can we assume, Frank, stability here? I mean, do we now know and we can operate on this set of circumstances and make an investment plan moving forward? Or do we continue to get changes from this White House?
Well, I think it's fair to say that we should brace ourselves for having more changes, more flip-flopping. I mean, we've seen so far, I mean, the track record has been, there hasn't really been any definitive goalposts with these things. I mean, there's still, tariffs are here to stay. I 100% believe that. But I also think that it's a moving target because it's still using it as a negotiation tool. And you also got to remember, when you're talking about tariffs, you know, it's part of, you know, a broader foreign policy agenda, right? You're not just dealing with a domestic policy where you control all the parameters around you. This is a trade war, so you have an opponent in front of you. So you're you know, if two parties are at war, you know, I was telling my team this the other day, and it's kind of funny to think about. It's like, if you and I are at war, I can't just get up tomorrow morning and say war is over, right? You have to you know, agree to a ceasefire.
Yeah.
So we you know, we say we have all the cards. Maybe we do, maybe we don't. But I think that, you know, you don't have full control on, you know, on what's going on because China is going to retaliate. You know, the EU is going to retaliate. They have to. That's just part of their prerogative as elected officials. You have to, you know, you have to do your job. So they're not just going to, you know, sit here and just take this. So it's going to be tit for tat. And we're in, like I said, it's grand opening of volatility season. This is just the beginning.
How do you invest around that? I mean, you know, you say that we have to wait for the first 100 days of Trump to
Yes.
see what it brings us. Yeah. But you can't just do nothing.
Yes,
right?
absolutely. I think that here's what when I made the comparison to 2022. If you look at the way, let's say, take the equities market, for instance, you know, we had obviously a bear market in 2022, but that bear market was basically saw a lot of, you know, pretty strong rallies, you know, off of oversold levels. I think it's going to be very, very similar. I think the way that the trade in a market like this, say in the equities market, for instance, to remind myself of one thing, you know, 2022, don't fight the Fed. I think 2025 is don't fight the Treasury. I think there's a put on yields. They want to bring yields down. There is a maturity wall coming in the fall, and they want yields to be, the 10-year to be in the 3 handle, somewhere maybe 350. And so, you know, you want to be cognizant of that. And until there's a policy pivot, again, similar to 2022, like as long as the Fed remains hawkish or remain hawkish in 2022, you had to respect the Fed. I think it's going to be very similar this year, where you have to respect the fact that they want to bring yields down. And I think their strategy, in my view, is based upon the fact that this is, if you're ever going to do this kind of fiscal restructuring and trying to bring debt levels down, and not just for the federal government, for the broad economy. I mean, we see delinquency rates skyrocketing and all that. So for them to be able to do that, there's technically, I mean, that's their view. I'm not saying necessarily that I agree with that, but their view is that the best way to do this is now, because you have equities are at all-time highs. I mean, yes, we drew down about, you know, 10, 12%, maybe 15 today. But in a grand scheme of things, if you zoom out, you know, equities have done really well over the last 4 or 5 years, right? So if that's the pain that we need to take to bring debt levels down, I think they're willing to do that.
Frank,
so we have to keep that in mind.
Great to have you on this morning. Thanks so much for coming in. We'll talk to you again soon. Frank Monkam there of Buffalo Bayou. Coming up, 25% tariffs on U.S. auto imports are kicking in today. We'll take a closer look at the impact on cars and individual sectors next. This is Bloomberg.
Blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
President Trump reiterating the tariffs on autos are effective today. That 25% levy expected to upend supply chains and increase costs for car makers, well, costs for consumers, I should say, as well. Let's bring in Bloomberg's Craig Trudell, our global car czar, for more. And Craig, you know, it's interesting. In one sense, there was a little bit of relief yesterday because there weren't additional tariffs on Canada and Mexico. And as long as you are within the parameters of the USMC, you can continue to get sort of carve-outs. Is that good for the North American auto market?
I do think that it is likely to be the case that we'll see some incremental production shift to the U.S. as a result of these tariffs. I mean, these are just not, not feasible for car makers to just sort of take it on the chin and continue on. This is an industry that doesn't have 25% to give, and not many do. But this one in particular, margins are quite thin. And, you're going to see companies look to try and shift, some models, perhaps look at new plants. Although I think one of the challenges that you're going to find, too, is that, we also know that the U.S. labor market is quite tight. And so, you already hear from some of the manufacturers that as they're trying to build new factories, Ford, for example, is building one in the Memphis area. It's difficult to find labor for these new plants, and so how much sort of ability will these companies have to staff these new factories, especially with the changes to immigration? That will be something that will be, really difficult for these companies to sort of sort out as they make these decisions.
What are you hearing, Craig, from European automakers? Volkswagen seems to be leaving its ships in port, those that are bound for the U.S., and planning an additional, I guess, import fee for sales in the U.S.
Yeah, I think that's probably the most interesting initial move that we're seeing from a major manufacturer, for them to put it right on the sticker for consumers to see. This is how much more it's going to cost you for the fact that we have to import these vehicles. And I can't imagine this will go over particularly well with the administration, because we have seen some members of this administration talk about this idea that the company should sort of absorb this and not pass this on to consumers. We've also heard Trump himself say he could care less about auto prices going up, but I think we certainly will see that happening at showrooms where it's just not feasible for these companies to be able to absorb that level of an increase.
All right, Craig, thanks so much for joining us. Craig Trudell there covers transportation for us globally out of London, leads our coverage there. I want to quickly bring you some headlines on Microsoft, and this follows on a couple of reports from Cowen that the company had pushed back against. But Microsoft now looks to be pulling back on data centers from Chicago to Jakarta. This is something we've been talking about for weeks, if not months now, but it does look like Microsoft is taking a harder look at its plans to build server farms powering the artificial intelligence wave and the cloud. The company has recently halted talks for or delayed development of sites in Indonesia, the UK, Australia, Illinois, North Dakota, and Wisconsin, according to people familiar with that situation. Shares of Microsoft and NVIDIA both down in the pre-market. Let's take a look at another sector that was particularly hard hit. Retailers are down big after the tariff announcements yesterday at the White House, some more than expected. Here's the CEO of Restoration Hardware, Gary Friedman, on the earnings call yesterday as the president made his announcement in real time.
We're just really well positioned right now. I think that's the headline. Like, if you're going to bet on somebody in this race, and I don't know how, where's our stock now? I mean, I guess the stock went down, based on some of the numbers we reported, and then it got killed because of oh, really? Oh, okay. I just looked at the screen. I hadn't looked at it. It got hit when I think the tariff came out.
We had to beep out the S word because of all the children watching Bloomberg television at 5:50 a.m. Joining us now out of London is Bloomberg Opinion's Andrea Felstead. Andrea, we've seen such big moves in the pre-market. I look at Deckers, I look at Lululemon, Ralph Lauren, Nike, all getting hit so hard. Is this just because their production base is in Southeast Asia?
Yes. What has happened is over the past sort of 10, 15 years, companies have been moving away from China to other Asian nations. And one of the big beneficiaries of that has been Vietnam. And obviously we didn't have any tariffs on Vietnam up to now from the Trump administration. Now it's been hit with a big tariff as well as other Asian nations. But Vietnam really is the big one.
In terms of the the reaction from companies. What are you hearing? I mean, in the car segment, Volkswagen has said they may slap an import fee on sales in the U.S. Are you hearing anything similar from other manufacturers?
Retailers haven't sort of talked about that. So far, they've really tried to put pressure on suppliers to share some of the burden. Now, I think the problem is these tariffs are so big, they're not going to be able to offset them from, passing things on to suppliers or re-engineering products. It's inevitable that consumers are going to have to bear this pain.
All right, Andrea, looking forward to what you have to say today. Bloomberg Opinions, Andrea Felstead. You can find her work on the terminal by typing OPIN GO. Coming up, we're going to get you set up for your trading day, and it's going to be a big down day. Futures off 3 to 4 to 5% on U.S. stocks, getting hit harder than stocks the rest of the world. This is Bloomberg. Let's get a look at what's ahead today. We start with initial jobless claims at 8:30 a.m. Eastern time. Then ISM services, PMI data at 10 a.m. Plus more Fed speak with Vice Chair Philip Jefferson at 12:30 p.m. and Governor Lisa Cook at 2:30 p.m. But of course, the biggest news of today was yesterday at 4 o'clock out of the Rose Garden in the White House. Those tariffs driving down futures now 3.25% on the S&P 500. NASDAQ futures down 3.7%. And you can see the 10-year yield at 4.05% continues to fall. This is Bloomberg.